Welcome everyone, and thanks for joining for this deep dive into the state of decentralization in Ethereum. I'm Francesco from Consensus, joined by my colleague Simon Brown, and we're thrilled to hosting this conversation with one of the Ethereum most respected researcher, Justin Drake from Ethereum Foundation. It's a pleasure to have you here. And what we'll discuss today. So we'll discuss a little bit about the most and kind of like important topics in crypto, decentralization. Now Ethereum is navigating the trade-offs, innovation, and challenges that comes with it. We will cover topics like rollups fragmentation, based rollup, pre-confirmation, value accrual on layer one, and whatever Ethereum should tax layer twos. Okay, so welcome everybody to these streams. Simon, Justin, you want to quickly introduce yourself? Simon, go for it.
Okay, cool. Yeah. So I've been working at a Consensus for about 3 years now. Most of the time as a researcher and advisor, and that's how I met Justin. And so we've done some work together when I was researching base rollups and pre-confirmations for Linea. And then most recently, my role has been leading the team that's building out the Consensus network state. For those who aren't familiar with that, it's basically an initiative to build a digital economic network to provide tools and infrastructure for people who want to build on Ethereum. So we can talk a little bit about that a little bit later. Yeah, so that's me.
Great. And I'm Justin from the Ethereum Foundation. I'm a researcher. Nowadays, I spend most of my time on the Beam chain. There are other topics that I have been, am very excited about, including base sequencing and native rollups. But I'm generally speaking trying to delegate these projects to other people and focus primarily on the Beam chain, which is this from scratch proof of stake 2.0, if you will, that hopefully will mean that Ethereum can enter this maintenance mode where the consensus layer is as robust as possible for the next decades and centuries.
Awesome.
Nice.
Thanks for that, Justin.
Nice, awesome. Yeah, I'm Francesco. I'm a leading developer relation. I'm super excited, and I will kick off with a quick question here. So let's start as kind of like his core. Is Ethereum today as decentralized as it aspires to be? And I mean, like, this is obviously like a marathon, is not a sprint. I just want to hear hear quickly your thought about it.
Yeah, absolutely. So I have a bit of a cheeky answer, which is that I think it's too decentralized. And the reason why I say this is because I have this mental model whereby when you want to build, digital systems, you have various options as to what you use as your foundation. So option number one is to use trust and reputation. And really we're trying to move away from trust. And this is a bit of a difficult to understand concept when I tell people that we're building trustless systems, because what do you mean like trustless? Isn't trust a good thing? And yes, trust in of itself is a good thing, but the fact that we need trust in the first place is a bit of a crutch, right? It's something that we use because we don't have any other option. And ultimately, when we build trustless systems, we're building more resilient systems. Now, the next best option beyond trust is to build on top of markets and to use incentives. And again, here, like the thing that we're leaning on is exactly what your question was about, decentralization, right? We want the markets to be very, very decentralized. And we have assumptions about the markets. We assume, for example, that half of the market participants weighted by stake, for example, are rational or honest. But it turns out that there's an even greater form of robustness, which is just pure code, pure cryptography, pure mathematics. And so really the question that I think we should be asking before asking, do we have enough decentralization, is, do we even need the decentralization in the first place? Can we build systems that are purely cryptographic as opposed to crypto-economic? And in my opinion, we can effectively remove the need for decentralization in almost all places. So traditionally, when you look at a blockchain, like a monolithic blockchain like Bitcoin, you have the consensus participants that are responsible for many, many things. And as a user of that blockchain, for example, as a light client on your phone, you are going to trust the consensus participants for many of those things. So, for example, you'll trust them for the validity of the state root, meaning that the correct execution of the transactions. You'll also trust them for something known as data availability, and you might trust them for finality and all sorts of other things like liveness. And what we've found over the last 15 years is that for many of those services that the consensus participants provide, we can do it purely cryptographically. We don't need to rely on decentralization. So in the case of execution, we can lean on SNARKs. In the case of data availability, we can lean on data availability sampling. In the case of finality, there's this really exotic piece of cryptography known as one-shot signatures, which basically prevents you from double signing, from equivocating. And so if you have a blockchain that has reached finality, then it can never it can never roll back and renege that finality. And really, if you look at the essence of what requires decentralization, it's ultimately liveness. So we need decentralization to make sure that the blocks keep on being produced and that there isn't this notion of censorship. But the good news is that with modern blockchains that are built on proof of stake, even that is not like absolutely critical. And the reason is that we have ideas around what's called 51% attack recovery, like semi-automatic 51% attack recovery. So long as the group of users of Ethereum, for example, are observing the system and detecting that there's something wrong, then they can identify an attacker which is causing such a liveness failure and fork them away, a little bit like identifying a cancer in a body and excising it. Now, this is something that is only possible with proof of stake, not possible with proof of work. And for the other things that I mentioned, you need the technology, which is only starting to reach maturity. So SNARKs only recently are starting to reach maturity. Same with data sampling. And one-shot signatures, unfortunately, is something that we're going to have to wait several decades for. And the reason is that it relies on quantum computing fundamentally. So the idea here is that your private key is a quantum superposition. And when you sign a message, you observe the key and you collapse it and you destroy it so that you can't sign a second message. Yeah, it sounds very theoretical, but the dream basically is to remove the need for decentralization. And actually, for some use cases, for example, for simple payments, we don't even need consensus at all. So we don't need decentralization. We can have what's known as quantum money, which is kind of a bearer instrument that you can send over the internet to any other person, and only these two entities need to know about it. So it's a little bit like a lightning channel, but you never have to settle to the blockchain to open and close the lightning channels.
That's fascinating. You've just introduced so many interesting concepts. We could probably be here for a week talking about them all. But like, without decentralization, do you think in the future, is there a place for the validator set? Do you think we'll always need the validator set? Or would you go to the extreme of saying that maybe one day we won't need a validator set?
So unfortunately, for applications like smart contracts, where there isn't like one specific owner of a piece of state, we can't completely get rid of the set of consensus participants. And so we do fundamentally rely on them for liveness. Now, another thing that I mentioned is that even though we can recover from liveness failures, it's better to not have a liveness failure in the first place, right? So we do want the barrier to entry to be extremely high so that liveness failures don't occur. And one of the facts of life is that there are incentives, financial incentives, for people to conduct these liveness failures. So, for example, you can censor oracles, or you can censor decentralized exchanges, or you could maybe censor fraud proofs and lead to incorrect optimistic rollups states. You can do also all sorts of bad things. And so we want to make sure that the potential reward that you get from conducting this liveness failure is much, much lower than the budget and the cost to perform it. And so this brings us to this notion of economic security. And above and beyond the fundamentals of economic security, I think there is a lot of mimetic power to having very high economic security. Because let's say that we have $10 trillion of economic security, meaning that in order for someone to think of doing such an attack, they need to muster trillions of dollars. It basically would give a system like Ethereum credible resistance against the most powerful attackers in the world, including nation states. And there's this meme of World War III resistance, and I think getting to that point is indeed valuable. And I also believe that purely from a vibes perspective, it's a better look, right, if the consensus participants are indeed very decentralized, just because we live in a competitive marketplace of blockchains with these strong network effects, and ultimately society needs to converge around one of them. So there needs to be these strong shelling points, and if everyone has the best technology, then what is the differentiator? Maybe it's something like decentralization from a mimetic standpoint.
Yeah, I think I agree with you on that point. From a mimetic standpoint, and more importantly, from the point of view of people trusting that the technology will actually serve them in terms of being, incredibly neutral, it is important to have like many participants and to be seen as being decentralized. So I agree with you on that point. But when you talk about the security budget, and like the security budget is basically all of the ETH that's staked by all of the different validators. And in Ethereum, that's what, 26-27% of the total supply, if I'm right. I think it's something like that, which is a huge amount of money. I don't even know how much that is in US dollars. So that provides like the security budget, basically the security for not just Ethereum, but like the broader idea of Ethereum and all of the rollups who inherit their security from the mainnet. And I'm just wondering, there's this sort of tension between this idea of like ETH as a utility token, which provides the security budget for the network, and ETH as an asset and a store of value. Because right now, obviously, the price isn't doing very well. Well, the price of nothing is doing particularly well. But ETH is still doing its job as an asset in terms of securing the network, right? And so is there a point to be made, like an argument for saying, so long as that security budget is there and it's providing the security, maybe the price doesn't need to keep going up, and maybe it doesn't particularly need to be like a store of value akin to Bitcoin. What are your views on that?
Yeah, so I actually think there's strong synergies between Ether as a store of value and Ether as the unit of security and collateral in the context of staking. And today, all of the ETH staked is roughly speaking $50 billion, which is a very high number in the sense that very few people can think of attacking Ethereum, but it's still tiny in the grand scheme of things, right? A nation state like China or the United States or Russia, they can easily muster hundreds of billions, if not trillions of dollars. And in my opinion, the only real way that we can reach these levels of economic security, the trillions of dollars, is if we start accruing monetary premium. And what is the definition of monetary premium? It's the multiplier on top and above and beyond the the valuation from cash flows, right? So you can think, if you want, of Ethereum as a traditional company that has income in the form of fees, and it has expenses in the form of issuance that needs to pay out to the validators and ultimately get sold, for example, in the form of taxes. And you can come up with a valuation there, but then these valuations are fundamentally going to be limited to the size of companies, right? And the largest company out there, is only a couple $1 trillion. So how do we get to the size of something like gold, for example, which is tens of trillions of dollars, $20 trillion? And the trick that gold pulled off is that a large part of its supply is locked up in bunkers underground and is just not moving. And only a small portion of its supply, let's say 10%, is actually circulating in the context of industrial use cases like phones and electronics. And the math actually works out pretty well, in the sense that if you look at gold as an industrial metal, you would assign it, roughly speaking, a valuation of $2 trillion. But there is this 10x multiplier. And where does the 10x multiplier come from? It comes from the fact that only 1/10 of the supply is circulating. And so whatever is not circulating is using gold as money, and is basically providing a valuation above and beyond that of the flows. Now, in order for the same thing to start applying to Ether, the asset, we need the cold economy of Ethereum, meaning the percentage of the supply that is not moving, that is used as a collateral asset, to grow roughly to something like 90%. And today, as you said, we do have 27% or so that's in the cold economy through staking, and we do have a few percent here and there in the where people are using Ether as a unit of collateral in DeFi, for example, to issue stable coins in the context of DAI, and that's going to lead to a little bit of monetary premium. But my hope is that as the internet of finance matures, there's going to be more and more of a need for this pristine collateral. And one of the prime examples here is stable coins. Like stable coins has been a massive success for Ethereum, but we need to remember that it's centralized stable coins that we have today, USDT and USDC. And my hope is that we have tens of trillions of dollars of decentralized stable coins one day. But the only way to get there is to have a similar amount of pristine collateral, for example, in the form of Ether, the asset. And the first person who can really crack the nut of decentralized stablecoins may greatly increase the valuation of Ether, the asset, if it leads to very, very large amounts of ETH being locked up for the purposes of issuing such a decentralized stablecoin.
Yeah, that makes a lot of sense. And obviously, as ETH accrues more value, it becomes more valuable as a chain that can secure more TVL. And I suppose that reference to nation states really kind of puts it in perspective. Because as you said, 50 billion that's staked currently seems like a lot of money, but probably not to like a huge nation state. But like the way you described Ethereum as sort of like a company, it kind of it reminded me of a tweet from Dankrad, and I found it here, so I'm just going to read it out. Dankrad Feist, a few weeks ago, he tweeted that currently Ethereum is making almost zero fees from both L1 and L2 transactions because it chooses to. If we were a company, we will put a reasonable price tag on transactions and raise it where there is congestion, but instead, we currently charge very close to zero for transactions and DA when there's no congestion, and the result is that there's almost zero fees. Looks bad when you want to evaluate Ether based on that. There's been a lot of talk about this recently. what do you think is your opinion on like whether or not we should, like the base layer as a protocol should be charging more for the settlement and DA it provides to all the various rollups, or do you think this is going to reach an equilibrium over time?
Yeah, so I do think that as owners of ETHD asset and as designers of Ethereum, we need to try and think about fee volume, and fee volume is the current fee price times the amount of gas used. Now, there's I guess two ways to try and increase total fee volume. Way number one is to increase the price, and way number two is to increase the total amount of gas used. Now, what we've seen in the past is that we were limited on the total amount of gas capacity. The prices went very, very high, and there's no way in which they could go like much higher, right? Once you spend $100 a transaction, there's very little demand for $1,000 per transaction. And so really the only like plausible opportunity is to grow the amount of supply. The other thing that I'll mention is that there are competitive forces out there, whereby if it costs $100 per transaction on Ethereum, and people can go elsewhere where it costs a tenth of a cent, then they might go elsewhere. Now, the good news is that what we're doing right now in terms of throughput, transactions per second, is absolutely minuscule compared to where we could be. So roughly speaking, a couple of years ago, we were doing 10 transactions a second. And in my opinion, the opportunity is 10 million transactions per second. So we have an opportunity to increase the total amount of gas used by roughly 1 million. And now the question becomes, by doing so, are we going to reduce the fees per unit of gas by more or less than 1 million? And my guess is that it's going to be by less. So fees might only go down by 10,000x. And so ultimately, if we can increase throughput by 1 million x, and we only decrease fees per transaction by 10,000x, it's 100x opportunity relative to where we were a couple of years ago. Now, one of my theses is that blockchains are winner take most, and there's strong network effects. Strong network effects around shared composability, shared security. And the basic intuition here is that as we move forward and mature as an industry, we're going to be building more and more complex financial constructs that are going to involve more and more money Legos. And these money Legos, each need to be highly composable, and they also need to share the same security. And the reason is that if one of them is kind of a weak Lego, that's going to be the weakest link in your overall financial structure. And so really what we want to be doing from a strategic standpoint is making sure that Ethereum becomes the place that wins the network effects, right? So right now we're in a period of growth. We're trying to attract as many builds as possible, build the strongest network effects. We're not really in a position to be extractive, especially in a competitive environment. Now, one might ask, are we ever going to be in a position to capture large amount of fees? And I think the answer here is yes. And the reason is that the one thing that is a fundamental bottleneck for scaling in blockchains is bandwidth. And the way that we deal with it on Ethereum is with this technique called data availability sampling. And what it gives us is that the total throughput of the blockchain is roughly 100 times the throughput of an individual consensus participant. But we put on Ethereum, we have this constraint around strong decentralization, and we assume that each consensus participant only has one home internet connection. And so really what we're saying here is that the throughput of all of the Internet of Finance, all of Ethereum is only 100 internet connections. And so we need to be asking ourselves, is there going to be more or less demand than 100 home internet connections? And I think the answer is kind of obviously we're going to have more demand than that. And so ultimately, data availability, block space is going to be a scarcity, and people are going to be willing to pay for it, and it's going to be highly, highly expensive. It's going to be maybe a tenth of a cent per transaction, and that's going to be considered expensive because a tenth of so one transaction in terms of bandwidth usage might be a millionth of a cent. So the user is overpaying by a huge amount, but because the amounts are so small on a per transaction basis, they're not even going to realize it. And 10 million transactions per second is about 100 transactions per day per human. And if the fee paid is 1/10 of a cent per transaction, that's $1 billion per day, right? So the numbers start getting very, very big, very, very quickly. So 2 cents, 2/10 of a cent, that would be $2 billion per day. And that's the kind of revenue that very large companies, like Apple or Microsoft are doing. And so we can expect the valuations from a flows perspective to be in the trillions of dollars, maybe low single digit, and then the monetary premium kicks in, and now suddenly you're in the tens of trillions of dollars.
Yeah, I mean, that really paints a picture that's quite bullish for Ethereum. So, I mean, if I was to summarize that back to you, what you're saying is that we're in a period of growth right now. We still have most of our adoption has still yet to happen, right? And so once we start onboarding more and more people onto Ethereum, then the actual individual price of transactions doesn't matter compared to the volume of transactions that we're actually going to see across the entire Ethereum ecosystem. And then Ethereum in general becomes more attractive, and then people will want to actually use it as a store of value as well as just for paying for transactions. Is that kind of more or less what a decent summary of your point is?
Yeah, exactly.
All right, cool. So, I mean, you're painting like a very bullish picture for the future of Ethereum, and one that I largely agree with, but I'm wondering what you think maybe are the biggest challenges for Ethereum on this journey.
Yeah, great question. Well, one of them, on the topic of decentralization, is that we've taken a lot of shortcuts, at least in the short term. So we've have this desire to scale as quickly as possible, and that has led to the fees being so low. But in the process, we've introduced centralization in various places. So one of them is the notion of a security council, right? Like almost all rollups out there has a group of people who effectively have unilateral control over all of the assets in the rollup. And one of the research topics that I've been thinking about recently is this notion of enshrined rollups, which is trying to precisely solve this problem. How do we remove the security councils, at least for the EVM equivalent rollups, right? Because today, if you are an EVM equivalent rollup, you have to do two things. First, you have to re-emulate the EVM within the EVM. So you basically have to rebuild the whole EVM from scratch. And then you get to run your application like Uniswap within the emulation. And the emulation is either going to be a fraud-proof game in the case of optimistic rollups, or it's going to be a snark circuit. And the emulation is just not going to be perfect. It's going to have security bugs, vulnerabilities. That means that the security of the overall rollup is potentially jeopardized. And there's an even more fundamental problem, which is that every time the L1 EVM changes, right? Because the EVM is a living beast, right? Every hard fork that happens roughly once a year will change the EVM. there needs to be corresponding governance within the EVM rollups to update the rules of the EVM to stay EVM equivalent. And so what native rollups are basically are rollups where you don't have to do the emulation. You natively have access to the execution layer of Ethereum, and you basically make use of a precompile called the execute precompile, and this execute precompile provides introspection into the EVM. So it means that the EVM is aware of itself; it has access to itself, which is something that that doesn't exist today. Another problem that we have is fragmentation. So in order to have money Legos compose with each other with the least amount of friction possible, we need to have a notion of a shared sequencer. So today on Ethereum L1, everyone has opted in to be sequenced by the same entity, which is the L1 proposer. And this one L1 proposer, can take multiple money Legos. For example, it can take Aave, and it can take Uniswap, and it can create transactions where Aave will liquidate on Uniswap. And these kinds of constructs are no longer possible across rollups. So you can't have, for example, Uniswap on Unichain and Aave on Aave chain, and you can't have this liquidation happen anymore unless you have the synchronous composability. And in order to have this, as I mentioned, you need the shared sequencing. But in order to have shared sequencing, you need to have a credibly neutral sequencer, because what's happening today is that every rollup team is coming up with their own sequencer. Usually it's a centralized sequencer, and it's impractical to believe that competitive rollups are going to all opt in to one of these sequencers. And so the one research topic that I've been thinking about is this notion of base rollups, whereby why don't we just reuse the L1 sequencer, which powers the L1 smart contracts for the rollups as well, because everyone agrees that the L1 sequencer is credibly neutral. And then another thing that I guess I'll mention, which is a shortcut that we took, is this notion of relays. So in the switch to proof of stake, what we wanted to make sure is that the long tail of untrusted stakers, which is going to be much longer than what we had with the proof of work mining pools, we wanted this long, unsophisticated tail of stakers to have the same economic opportunities as the most sophisticated ones, who could have like direct access to block builders. And so we introduced this notion of a relay, which allowed for that. But going back to the question of decentralization, it's best to just remove relays entirely and just rely on cryptography, as opposed to having to worry about a local maxima where we decentralize the relays in some form. It's just much cleaner to altogether remove them. And the idea here to remove them is called APS, attester proposer separation.
And by the way, I think it's a good segue to actually the pre-confirmation gateway, because you wrote a lot about this, Justin. Like, you want to explain a little bit how those pre-configs fits into the biggest kind of decentralization picture? Super interesting.
Yes. So pre-confirmations relate to base sequencing. So base sequencing is effectively extremely good on all of the metrics, right? Especially credible neutrality, security, and its potential use as a shared sequencer. But it has one critical issue, which is that it has 12-second slots, right? Because that's how fast the blocks get produced on Ethereum. And nowadays, 12 seconds is considered extremely slow, especially in the context of centralized sequencers that have been able to dramatically reduce the slot duration. So for example, Arbitrum has 250 millisecond slot durations. So how do we solve this problem? Well, it turns out that you can introduce this new concept called a pre-confirmation, which is that the entity that has the sequencing rights during those 12 seconds can start making promises to users that they will include their transactions at the end of the slot uh, in a specific position. And so, for example, if you are a user and you're making a Uniswap trade, you can know halfway through the slot, how your trade will execute, what price you're getting, what fees you're paying, and if it so happens that the sequencer, reneges the promise that they made, so they cheat and they don't include your trade, well, they get slashed. So they have a high financial incentive to honor the promises that they've made, and that gives really high quality of user experience and very low latency. It basically reduces latency down to 1 ping time from the perspective of the user. It's just the time it takes for information to go from the user to the sequencer and back to the user. And so there's this kind of notion that I have of slot abstraction, right? If you have a well-designed decentralized system, the user doesn't even know what the slot duration is, and they don't even care, right? Because all they see is that they have this instant, Web2-like UX where they're getting their transactions pre-confirmed immediately. Now, pre-confirmations are a bit of a new topic, which hasn't fully been understood and digested by the community. But in there's a couple of things that I'll say. The first one is that we're starting to see more and more signs of pre-confirmations, hitting mainnet. So, for example, Base recently announced that they have on testnet 100 millisecond pre-confirmations, right? And that's the technology. This technology, even though it's in the context of their centralized sequencer, so you could say it's centralized pre-confirmations, it's forward compatible with a decentralized sequencer. So if and when they move away to a decentralized sequencer, all of the pre-conf infrastructure stays. And one thing that I'll mention as well is that I believe that every decentralized sequencer will have pre-confirmations. And the reason is that what is a decentralized sequencer is one that has a reasonably large amount of consensus participants, attesting every slot. Let's say at least 1,000 of them. Well, it takes a while for 1,000 participants to all make signatures and to aggregate all the signatures and gossip them through the network. And so realistically, it's going to be very, very difficult to bring the slot duration under, let's say 1 second. And so when you compare the pre-confirmations, which are on the order of 10 milliseconds, it's 2 orders of magnitude faster. And so because pre-confirmations are permissionless, it's not something that you need support for at the consensus layer. It's something that anyone can do. It's basically a bilateral agreement between the user and the sequencer. It can happen permissionlessly. I expect this infrastructure to be commonplace in the US to come.
Very, very cool. We've covered a lot of different things, from enshrined rollups to based rollups to pre-confirmations. I can see how enshrined rollups can be incredibly useful for a number of reasons, especially because, as you said, Ethereum is undergoing a hard fork now, like an upgrade, like every year. And I think I heard you say recently that we're like, as a community, we're aiming for like 2 a year. So that means that, that's an enormous pressure on all of the various different L2s to upgrade their various networks to remain in lockstep with the base layer. Enshrined rollups, I take it, just kind of like alleviate that because everyone's using this single base layer for execution. And then when you combine that with base rollups, then you get like not just across the board EVM equivalents, but you also get decentralized sequencing. And then with the pre-confirmations, that makes it even more attractive. I think for pre-confirmations, like as you pointed out, in a lot of L2s, users are already getting pre-confirmations, and they're almost getting near instant transactions. So the pre-confirmations, is it really something that you feel more when you're actually moving funds between different rollups in terms of like the composability? Is that where you see the most performance improvement for pre-confirmations?
So at first approximation, pre-confirmations don't help with composability. The only thing they help with is latency. So traditionally, with a blockchain, the user gossips that transaction, and then it gets included in the next block. And so the observed latency is roughly on the order of 1 slot. With pre-confirmations, you reduce 1 slot to 1 ping time. Now, the reason why I say at first approximation it doesn't involve composability is because if you connect the dots, in order to get synchronous composability, you need shared sequencing. In order to get shared sequencing, you need a credibly neutral sequencer. In order to get a credibly neutral sequencer, you need base sequencing. And in order to get base sequencing, you need to get pre-confirmations, because otherwise the base sequencer is not attractive from a UX standpoint. So it's kind of this domino meme where base pre-confirmations kind of unlock everything, including this glorious method of composability known as synchronous composability. Now, one thing that I do want to stress is that shared sequencing is actually not sufficient to unlock synchronous composability. It's necessary but not sufficient. So the other ingredient that you need is real-time proving. Real-time proving is this technology that allows one rollup in real time to withdraw assets and send messages to other rollups trustlessly. And so what is synchronous composability? Synchronous composability is this idea that you can have super transactions that have sub-transactions within the L2s, and these sub-transactions will make withdrawals of assets and will send messages in real time, so that this super transaction is effectively stitching together the state of multiple rollups. Now, the exciting thing from a timelines perspective is that next slot real-time proving is happening in a matter of months. Actually, it's kind of already happened internally within some of the ZKVM teams, and there's going to be various announcements that are going to be made over the coming months. And there's also a website out there, eveproofs.org, where you can track the progress. Once in order to make use of this real-time proving to get synchronous composability, there is like one other thing that we need, which is this notion of delayed execution. So right now on Ethereum, we prove we have the state root for the current slot included in the current slot, and what that means in the context of native rollups is that they would have to provide proofs in the current slot. So that's a flavor of real-time proving, which is known as same slot real-time proving, and that's extremely difficult because it's potentially on the order of hundreds of milliseconds, and it incentivizes proving races where the lower the latency you have, the more of an advantage you have for MEV and your ability to include transactions. And so we want to try and remove these MEV races, and we want to allow for a whole slot to do the proving, and for that we need a hard fork, which is known as delayed execution. But once we have all of those ingredients, we have a credibly neutral shared sequencer with pre-confirmations, we have the next slot real-time proving, and we have the delayed execution. Then we can start dreaming of reunifying the state of Ethereum.
I think it's great how you're able to just tie together so many complex threads into a really clear picture of where Ethereum is going. And I think it's really important. I think we shouldn't shy away from exploring complex technical topics with just like the community in general. And I think it's a testament to that how many people have tuned in and are interested in this, and are really like eager to hear about all of the different things from enshrined rollups to base rollups to delayed execution to pre-confirmations and everything that entails. So it's great that you're able to explain it so succinctly. It's brilliant. Do you foresee any risks? Just curious with any part of that roadmap that might potentially go wrong, or something that we should pay more attention to or think about potentially mitigating?
Yeah. I mean, one risk is that it takes a while to build out all of the infrastructure, and another risk, I guess, is that we need to make sure that the incentives are aligned, and it is possible that we will live in a world where the incentives for shared sequencing are not aligned, where basically every rollup is incentivized to be as isolationist as possible so that they capture MEV. So one of the big trade-offs of shared sequencing is that the rollups need to opt in to the shared sequencer, and by default, they lose access to the MEV that originates from their transactions. And the way that the economic analysis works is that you need to look at the two sources of income for the rollups. There's congestion fees, and then there's contention fees, which is MEV. So congestion fees basically comes from the fact that any given rollup will have a gas limit or gas target, and anytime there's more demand than the virtual machine can supply, the base fees go up, and these are fees that can very easily go to the treasury of the L2, regardless of the sequencer. Having said that, the MEV will flow to the sequencer. And so really what we need to look at is the ratio of congestion fees to contention fees. And how does this change as you opt into a shared sequencer, which unlocks more traffic and therefore more congestion and more congestion fees. And my hope is that we end up in a world where MEV is about 1%. So it's very, very small relative to the congestion fees. And by opting into a shared sequencer, you maybe double, triple, quadruple, quintuple your congestion fees, because your state becomes that much more valuable that so many more transactions want to go and access it, and are therefore willing to pay for the privilege of flowing through your virtual machine. And the reason why I believe that MEV as a fraction of income will go down is because as the space matures more and more, what we've seen is that MEV flows back to the originator. So if you think of the MEV pipeline, you have the user, the wallet, the application, and then you have maybe the searcher, the builder, the proposer, and basically the proposer is at the very, very end. And just because of unsophistication, all of the value just dropped to the proposer. You can think of it like water, right? Like there's water originating from the user and it just drops all the way down. But what's going to happen is that as the intermediaries become more and more sophisticated, they're going to capture that water before it lands at the very bottom to the proposer. And what's going to be left for the proposer is just like a few drops here and there, which are going to be so small that they can ignore them. And this brings me to the concept of the MEV gambit, whereby it's more valuable to get rid of your MEV by opting into a shared sequencer, and in exchange, gaining much more congestion fees.
It makes sense.
Fascinating subject.
Yeah, no, I just want to say super interesting. And Justin, I think we're coming almost at time. And I have a couple of kind of closing question. I just want to ask you, Simon, because we didn't kind of grill you here in this live stream enough, right? So I want to ask you, like, how all this, because you're super passionate about, network state, how actually this relates to consensus network states?
Yeah, I'm glad you asked that actually. Yeah, I started doing these live streams with you really as a part of it, sort of like exploring all things network state. And yeah, so I mean, the consensus network state is this idea to build this sort of, autonomous, sovereign digital economic network. And it's really to empower people who want to build on Ethereum using various tools and infrastructure that consensus has built and other people across the ecosystem. So I mean, the thing is, like, we're sort of striving to become like the, almost, I suppose you could say, the connective tissue between companies and collectives and communities, so that they could all work together toward this sort of common goal of prosperity. But we can only do that if we're decentralized and if we're seen to be decentralized. I think that it's one thing. I mean, it's great to see so many people working so diligently and conscientiously on maintaining decentralization from a technological perspective. But I think its value is undermined if people don't see it. And I think it's really important to communicate decentralization so that people really understand it and understand how it works and really put their faith in Ethereum. So that's kind of like why this what prompted me to explore this with Justin. And I think
Nice.
Justin is probably one of the best people at really explaining really complex technical things in a way that's accessible to people.
100%. Yeah. And I think also the role really, advocating for decentralization is also coming from the community, right? I would say, like, for everyone out there. And so let's two questions, Justin, here. Like, so what are kind of like the question nobody's asking you, when it comes to kind of decentralization that you wished you will be asked for?
Yeah, so I have prepared some notes, and like one interesting factoid is that is basically the analysis of fossil. So right now we have this market of builders, which is technically permissionless. So it falls under the second bucket of markets, but the market is extremely concentrated. And the solution that we found there to mitigate the primary concern, which is censorship, is to introduce a second market. And what the second market does is that it takes on most of the load that the primary market does, but it requires almost no sophistication. And specifically, the load that it's taking is inclusion. So today, the builders are responsible for two things. First of all, to include transactions on chain, but also to order them, to sequence them. And the inclusion is kind of really, really trivial. All you have to do is connect to the mempool and then concatenate all of the transactions, maybe sort them by priority fee, and then include them on chain. On the other hand, the sequencing is extremely difficult because you want to do sandwiching, you want to do arbitrage, you want to insert your own transactions here and there, and so the idea of introducing a second market in some sense goes against what I said previously, where we want to remove the need for markets and replace it with pure cryptography. But here there's a very, very good reason to introduce a new market. It's because it reduces the barrier to entry and therefore greatly increases decentralization. And specifically, what we can do is that we can not only leverage the decentralization of the staker set, but we can amplify it. So instead of having just one includer per slot, which is what we currently have, we can have 16 of them. And so we're greatly reducing what's called the honest minority assumption. So in order to get a transaction on chain, we need at least one person to be willing to do it, but that one person might only come by once every 10 minutes, for example. And so if you're a censored transaction, it would take you, in expectation 10 minutes to get in. But if you have 16 of them in parallel, then you're greatly accelerating the pace at which these entities would come in. But not only can we leverage the set of consensus participants, but we can also leverage anyone who wants to just help out from the goodness of their own heart. So with the Beam chain, one of the ideas is for anyone to just be an includer without being an attester. So they can put forward ETH, and every once in a while they'll be selected as an includer, and every once in a while they have the privilege to be able to include transactions on chain. So anyone who cares really, really deeply about censorship resistance will have the option to help out even without being a staker.
Nice. I think this summarizes everything. And the last question, 1 minute, and this is more on a personal level. Like, what kind of keeps you personally optimistic on Ethereum decentralization roadmap? So we want to hear kind of the personal Justin. Yeah.
So the thing that I'm personally excited right now is zkVMs, and just the pace of innovation with snarks is just mind-boggling how fast these snarks are becoming. So as I mentioned, there's this website ethproofs.org where we show two things. One is the cost to do the proving of EVM blocks, and it's gotten so low that it's just a few cents per block nowadays, and it will become sub-cent relatively soon. Like rough ballpark numbers is that the cost decreases by 5 every year. So it's like Moore's law, but on steroids. What we're also seeing is that there's a huge effort towards the real-time proving, as I mentioned, where once you've crossed this 12-second barrier for latency of the snark proofs, a whole world of application unlocks. And Ethereum seems to be the only blockchain that's really making big use of this real-time proving. It unlocks the native rollups. It unlocks synchronous composability. It unlocks post-quantum signature aggregation. And maybe the most important of all is that it unlocks a dramatic increase of the L1 gas limit. Because today, what is the main bottleneck to increasing the L1 gas limit? It's the validators that are assumed to be running on weak hardware like Raspberry Pis. And so we have 36 million gas. But if instead of naively re-executing blocks, they were to verify snarks that were given to them within one slot, then the gas limit could be raised 10x, 100x, 1000x. And so what I'm hoping we can do in relatively short order is, first of all, have the hard fork for delayed execution. Secondly, have more and more validators, especially the weak ones, update their execution layer client to be a ZK execution client. So you go from Gef to ZK Gef, or Ref to ZK Ref, or Besu to ZK Besu, and then we have the validators vote for a much higher gas limit because they'll be able to support any gas limit.
Amazing. So many reasons to be bullish about the future of Ethereum, and so much to look forward to. So as I said, Justin, explaining all of those complex topics inside of an hour is no mean feat, and you did it very well. Very impressive. Thank you so much for joining us today. And yes, anyone who's tuned in today, there will be other live streams with other interesting topics. So follow myself, Francesco, and yeah, we'll let you know as soon as they drop. But again, Justin, thank you so much. Today's been really, really great.
Amazing. Thanks so much for having me, Francesco and Simon.
Thank you so much.